We're now going to move out of the world where we don't have any default risk on bonds. So we're moving out of the world of treasuries. We're now going to consider that their payments on those bonds or those scheduled payments are not made. And if they're not made, we may lose all or a portion of the following payments from that bond. So we're moving into that world, so we've got to evaluate the risk of those bonds, and that is what this module 2 is about. I'm going to ask that you do 2 readings for this module, both of them on our website. Very short, they're both Investopia articles. Just give some background about credit rating agencies and what is a credit rating. Um, we will use those later because one of the things that we often look at when we look at bonds is their credit rating, and that's done by credit rating agencies. So we'll talk about that in this module. Risky bonds, as we've said before, have a chance of a default. And a default is, by definition, a missing of a scheduled payment. And a default can range. It can range from missing a payment by a day and just getting a payment late by a day. That is a default. Or it can range to bankruptcy and no payment. So if a corporation or city or municipality goes bankrupt, then we will get no payment on those bonds. Examples of risky bonds are corporate bonds and municipal bonds, and obviously the risk associated with a corporation, or for that matter a municipality, varies. So some, for example, corporations will have low risk, and some bonds will have, or excuse me, some corporations will have high risk. The risk that a corporation or municipality then faces will impact the interest rate that is received or the yield to maturity on that bond. Higher the risk of default, the higher it will be the interest rate on that bond. One way of looking at bond payments is to view it in this framework given here. The interest rate on a bond will equal the base rate, which you can think of as being maturity dependent and is basically set by the treasuries. Treasuries are no default risk, and so they are the base rate. To that, we add a spread or a risk premium, and that spread or the risk premium goes up the riskier the bond is. So if we have a very risky bond, it will have a higher interest rate. And that's the basics of interest rate structure. The issue for bond yield to maturity and pricing is assessing the risk that is faced by that bond. Here is a way of thinking about those interest rates or structure of interest rates in a graphical viewpoint. Generally, at the bottom, and now I'm going to go from the base axis or at the bottom of the vertical axis and on up. So let's take that 3-month. So there's a 3-month treasury which will have the lowest interest rate, and then there will be a series of bonds on top of that. And you'll see AAA, AA, single A, then triple B, double B, single B, and then finally junk. As you move up that axis, the interest rate on that bond will increase because AAA, AA, single A is a measure of the risk of the bond. And AAA is the best risky bond in terms of having the lowest risk. AA has more risk than the AAA. Single A has more risk than the AA. Then we go into the Bs. So as we move up that axis, vertical axis, we will have a higher interest rate. Junk bonds are very high risk. Those are high risk bonds. You also see these bonds referred to as high yield bonds. High yield bonds mean that there is a lot of risk. So if you see high yield, high performing bonds, it means that there's a high interest rate, but it also means that there's a great deal of risk. So the primary way you get a higher yield on a bond is to get higher risk. You also see there that there's horizontal axis, 3 month, 6 month, 12 month, 3 year, and 5 year. Again, that is your traditional yield curve. So length of time to maturity will also influence the bond yield as well as the 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 uh, the risk of the bond. You can think of the credit risk or the default risks as being composed of two portions: a default rate and a recovery rate in default. And here we give an example. The default loss rate is based on a default rate, which is the percent of times that a bond will go into default. Here I give an example, and it's in the blue, of 3%. That means that 3% of the time a bond will not make its scheduled interest payments, which also implies that 97% of the time it will make its interest payments. And as that number goes up, 3, 4, 5, generally you think about the risk of that bond increasing. The second piece of default loss risk is the recovery rate. And let me give you an example here. I have given an example here of 40%. What that means is you get 40% of your scheduled payments. Let's take an example here of you miss a payment by a day. You have defaulted, but on the next day you make a full payment, or the bond makes a full payment. That is a default. It has happened, but in this case, the recovery rate would be 100%. You might put it at 99.99 because there's a small interest rate reduction there, but close to 100%. The other extreme on that would be of the recovery rate would be you go of the corporation or municipality goes into bankruptcy and you get 10 cents on a dollar. In that case, the recovery rate is 10%. You can see there that those two combine together to give a default loss rate. This is given in the red here. Default loss rate in this example, we had a 3% default rate. We have a 40% recovery rate. We have a default loss rate of 1.8%. This will be the major portion of the risk spread. All right, and as the other portion of it will be, you will want a bondholder will want a profit for holding that risk, but there is a default loss rate, and as that goes up, the price of that or the yield on that bond will go up, the price of the bond will come down. So, default losses. Again, just summarizing what we stated on the last slide: higher default rate, higher default losses. Lower the recovery rate, higher the default losses. I will ask you to apply that formula on the exam. Fairly simple and fairly straightforward, but I will ask you to apply that on the exam. Couple points here. Credit risk and determining this is what many people spend much of their lives on. If you are in a lending institution, and you're a credit analyst, essentially what you are doing is assessing the credit risks that exist out there. You might do that on a single bond, or you might single loan, or you might do that on a portfolio. But whenever an individual goes in for a loan, there is a method for estimating the default losses that exist. For publicly held bonds, such as corporate bonds or municipal bonds, there are services that do credit analysis. They are firms such as Moody's, Standard & Poor's, and Fitch, and these firms do credit analysis. They determine the bond ratings for publicly held bonds. So when you're buying a publicly held bond, if you would buy any corporation, you would know its credit rating given by one or of these three organizations, or there's a couple others. Over time, these credit agencies will upgrade or downgrade the credit rating of the corporation. In general, upgrades will result in higher bond prices. Downgrades will result in um, lower prices. Again, what you expect when you see a credit rating decrease is that there's more risk there, so you have to have a higher yield to maturity to compensate yourself for the risk, which will drive down the price of the bond. The one portion of that is, if you're looking at that from a market perspective, you would need to know whether that credit rating was anticipated or not. These credit rating agencies consider factors, obviously, when they make their credit rating determination. Those determinations include the protections offered to the debt holders, and here this can range. All right, you can be a senior holder of debt. For example, if you and this is the individual that is the highest in line to receive payments in the case of bankruptcy. So if the person has a mortgage or a lien or is the first in line, they will have more protections than somebody that doesn't have a subordinate structure in that loan. Second factor that you see listed there is collateral, and the more and better and the higher the value of the collateral, the lower the default risk will be. And finally, the ability of the issuer to make contractual payments will be considered in its credit rating. This is a table from the second Investopia article, but it shows the bond ratings for Moody's and Standard & Poor's. So we have in this case, you'll see the AAA, AA, single A, B's, C's, and D's. You'll see in the third column there two denotations. Investment grade will be higher grade bonds. Junk are those there's high risk of default and low recovery rates. Again, if you're looking at the yields from those, the yields increase as you go from investment to junk. Risk, and you see listed there, lowest risk are AAA. Highest risk are those that go up into the B's and C's. So the ratings of the company relates to their assessment of the risk associated with those companies. That same would be true, I just used the word companies, it could also refer to municipalities. These two slides are from research that has been conducted a couple years ago now, but what they did was look at AAA, AA, and other bonds and see the default rate on those bonds. And let me just take one line of those. AAA, Altman. Altman is a credit rating agency, and you can see the cumulative default rate there is related to years 1, 2, 3, 4, 5, and up to 10 years. As you can see for Altman, there was a zero default rate in year 1. By the end of year 10, 0.09% of the bonds that were rated AAA had gone into default. Point here to note that as you go down the list, A's, you have less AAA's, you have very low chances of a default. Down to C's, you have a 60% chance of default in the course of 10 years. So it gives you a feel here for the default risk of these bonds and what they've historically done. Again, AAA is the least risky, CCC is the most risky. Here's another example of that credit analysis, and here we're looking at recovery rates. So now the bond has gone into default. What is the recovery rate on that default? This is done by year, 1983 through 2006, and it's done by loan position as indicated in the top there. Secured bank loans means that the loan is secured with some sort of collateral. Senior secured debt bonds would be those that are highest on the list as far as if a bond goes into bankruptcy. And then as you move to the right, senior unsecured, senior subordinate, junior subordinate, they go down the chain. So senior secured bonds will get paid first, senior unsecured bonds will get paid second, and so on. You can see there that the recovery rates are relatively high, except for junior subordinate bonds. They can be low in several years. But the security offered by the bond does have an impact on the recovery rate. Again, that's an important point that will impact both the ratings and if you're buying a bond, you should know where that bond is at in the security structure. To summarize here, we've talked about rating or evaluating bond risk. We do that by looking at default loss rate, which is a combination of default rate and recovery rate. And credit analysis is the process of assessing both of those items. And we have public agencies that do that for publicly traded bonds. So we can get a credit rating from for a publicly traded bond from one of the credit agencies that you saw listed here.